Hi, I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree.
And I'm Jeff Weniger, head of equity strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets. All right, we're talking stagflation today, Kevin. Earlier in both of our careers, you kind of got laughed out of the room if you even broached the subject of the flation that starts with stag, but now it's something that's on everyone's mind. We don't really know whether or not it will have the staying power, but certainly in the discourse. We had who was talking about stagflation? Jay Powell was talking about it. So should I be respecting it or disrespecting it?
Yeah, it's a great question. It seems like every few years, the media kind of brings up stagflation. I think it gets a lot of clicks, which is why people look at it. But I thought it was interesting. Powell said, hey, look, I was around in the 70s, 1970s. I saw stagflation, and right now I don't see the stag and I don't see the flation. And I think that was a real good way for him to kind of put it into context, what we're talking about here. Some historical perspective, all right? So you mentioned it. There's the stag that refers to the economy, to growth, the unemployment or employment situation. And of course, flation speaks for itself. So, I mean, you just go back to the 1970s. So, say 1974, 75. GDP was in negative territory through the first quarter of 75. The unemployment rate was 9%. Core CPI was 11.7%. And just look at the numbers now. They're not anywhere near what we were experiencing back then. So I thought Powell did a good job of putting it in perspective, because I think sometimes we tend to oversimplify things and just try to label something that it really isn't.
And we had the 1.6% GDP report. That's not exactly piping hot, but then again, it's not. Stag would seemingly, I would imagine, mean a recession from time to time, but we're not in recession right now.
No, I mean, you look at the GDP report, and I think that's what also helped to give rise to it, right, for the first quarter, that you had lower than expected growth, higher than expected inflation reading came in from the BEA, the Bureau of Economic Analysis, who produces the GDP reports on a monthly basis. But if you go under the hood a little bit, right, and you consider GDP growth, there's 5 cylinders of the engine. And if you really take trade and inventories and government spending, they can be volatile from quarter to quarter. So what you really want to look at, what are the underpinnings for the economy? Consumer spending and business and residential investment. And when you look at those numbers over the last 3 quarters, they're growing over 3%. So I think we can put the stag to rest for now. And even the flation part, as I mentioned, right? I mean, we're nowhere near where we used to be, but it is proving to be a little bit sticky. And I think that's been the concern from the Fed, is that disinflation trend we saw last year has kind of petered out.
Well, let's think about this. Back in the 90s, 3% inflation, sometimes 4% as a matter of course. And now we've gotten ourselves as a society anchored to 2. Does it really matter if 3 is the new number on a headline CPI type situation? You can feel it from officialdom that they're trying to guide that way, like they can't really get to 2.
Yeah, it's interesting you say that, because it's an observation you can also make about interest rates, right? You kind of get used to a certain setting, and saying 2% inflation. It was actually below 2% really up until this latest surge that we had seen. And I think the markets, investors kind of get used to that type of lack of price pressures, right? So that all of a sudden 3% becomes perhaps something more meaningful than it really should. And I think we've seen that with interest rates, that we're no longer at negative 0, 1%. And all of a sudden, investors are saying, hey, geez, we've got 4 to 5% risk-free treasury yields out there. They have to come down. And what we're finding out is that, no, perhaps this is the new normal, not just for rates, but also inflation, that maybe that 2% threshold is unrealistic.
And as I know, we'll try to keep the time tight here. Give me a quick view here on rate cuts from the Fed this year. What's going to happen?
Well, unfortunately, we got into, could they raise rates? And I think Powell blew that one out. So now I think maybe 2. You look at the dot plot is for 3. I'm thinking 2.
All right, perfect. All right. Thanks, Kevin Flanagan. Much appreciated.
Thanks, Jeff.